You click buy, you open a trading position, and instantly, like before the market even twitches, your screen flashes red. You are already losing money. Welcome to the deep dive. Today we're looking at a stack of financial tutorials and broker guides to figure out exactly why this happens.
Yeah, it's a super frustrating moment for a lot of people.
It really is. So we've custom tailored this deep dive just for you, the listener. And our mission today is to decode the bid-ask spread and figure out if the house always wins. So I keep coming back to this analogy. Is the spread basically like a highway toll booth? Like you have to pay the toll before you can even start driving toward a profit.
Well, I see why it feels like a toll booth when you're just staring at a negative balance right out of the gate. But it's not an arbitrary penalty or a fine or anything like that.
Okay, then what is it?
Think of it more as compensation for risk. The broker or the market maker is taking the other side of your trade. They are taking on the risk of holding that currency. So they buy it from you at a lower price and sell it to you at a higher price just to protect themselves against the market moving against them while they hold it.
Oh, I see.
Yeah, it's really simply the mechanical reality of two-way pricing.
Okay, so they're absorbing risk, and I'm paying for that service by buying high and selling low. That makes sense conceptually, but what does that gap actually look like to my wallet? Like, are we talking pennies, or are we talking hundreds of dollars every time I click buy?
That entirely depends on your position size. Let's look at the euro to US dollar example from your sources.
Okay.
Say it's quoted at 1.08420 for the bid. That's the price you get when you sell.
Right.
And then 1.08430 for the ask,
Yeah.
the price you get when you buy. So that gap is 0.000010, which in Forex terms is 1 pip.
Wait, so if I buy at that higher ask price and then I immediately panic and hit sell to close it out without the market moving at all, I'm forced to take the lower bid price.
Exactly. You are covering the cost of that gap.
Yeah.
Yeah, and to answer your question about your wallet, if you were trading a massive position, what the industry calls a standard lot of 100,000 units, that tiny 1 pip gap equals about $10.
Okay, $10.
But if you scale down to a micro lot, which is just 1,000 units, that exact same 1 pip spread only costs you about 10 cents.
Got it. The spread is constant in terms of pips, but the actual dollar hit depends on how much currency I'm throwing around.
But wait, earlier you mentioned this gap is about the market maker's risk. Risk changes, right? So does the size of that gap change depending on what's happening in the world?
It absolutely does, yeah. And this is where we have to distinguish between fixed and variable spreads.
Okay.
So some brokers offer a fixed spread, which stays at a stated level under normal conditions.
Which sounds nice and predictable.
It is. It's great if you want predictable cost planning for your portfolio. But the trade-off is that the baseline cost might be wider to begin with. Variable spreads, on the other hand, constantly shift based on market liquidity. That sounds exactly like rideshare surge pricing. Like if I want to ride on a quiet Tuesday afternoon, it's dirt cheap. But if I'm trying to get a car during a sudden geopolitical thunderstorm, it gets painfully expensive.
Surge pricing is a really great way to think about it, actually.
Yeah.
But unlike a rideshare app where it's mostly about driver availability, in Forex, it's about volatility. When central banks make surprise announcements or, during holidays when fewer people are trading, liquidity thins out.
And market risk spikes.
Exactly. Market makers widen the gap between the bid and ask rapidly to protect themselves. It's an accurate reflection of current market conditions, not a glitch in your platform.
Man, if these spreads can randomly surge like that during big news events, wouldn't that completely destroy the strategy of someone who trades constantly for tiny gains, like those scalpers you read about?
Oh, it would wipe them out entirely. Scalpers execute frequent trades targeting movements of maybe 2 or 3 pips.
Right.
So if the spread suddenly widens to 4 pips, it consumes their entire potential gain before they even start.
That makes sense. So they need tight spreads.
Yes, they demand incredibly tight spreads. Contrast that with a swing trader who holds a position for days or weeks looking for a 50-pip move.
Oh, they don't really care?
Right. To them, a 2-pip opening spread is a tiny fraction of their expected moves. They care far less about the spread and much more about the larger market trend.
That really changes how you look at those flashy ads for commission-free or zero spread accounts. Like, if the spread is just a natural market mechanic to offset risk, a zero spread account must be making up the difference somewhere else, right?
Oh, absolutely. The house always gets paid.
Yeah.
A zero spread account might just charge you a hefty separate commission.
Which is a flat fee.
Yeah, unlike the spread. The sources make a really strong point here.
Yeah.
Don't just look at promotional minimums.
Because they're hiding the real cost.
Right. Whether you're trading independently or using a platform like Monaxa, you need to watch the live quotes and compare the total round-trip cost. And keep an eye out for slippage too, which is an entirely different issue, where the execution price jumps because the market is moving too fast.
Wow. Okay. So for you listening, conquering this built-in transaction cost really comes down to managing your position size and not over trading to chase a fraction of a pip. You just have to factor the spread into every single trade.
That is the bottom line.
Which leaves me with one final thing to chew on.
What's on your mind?
So we're living in this era of high-frequency trading, right? Algorithms are getting infinitely faster at matching buyers and sellers. If the technology eventually reaches absolute perfection and risk is calculated to the microsecond, could the bid-ask spread eventually shrink all the way to zero? Or will human panic and just the unpredictability of the real world always guarantee a gap?